Thank you all for joining us today for the third part of our pandemic webinar series as we discuss the effects of COVID-19 on private capital. My name is Keith Crouch and I'm an Associate Director of Product Management here at Burgess, where I focus on the Burgess Manager universe. Now, for those who might be less familiar with us, Burgess is a leading provider of analytics and data solutions for global investors of private capital. And within those solutions, the Burgess Manager Universe is our research quality database, which includes the complete transactional history for over 10,000 private capital funds and the performance information for nearly 90,000 underlying investment holdings. This is the data set powering today's discussion. Now, we are joined today by Tim Jenkinson and Louise O'Shea. Now, for those who don't know Tim, let me provide a quick background. He is a professor of finance at the Said Business School at the University of Oxford, and he is considered one of the leading authorities on private equity, IPOs, and institutional asset management. Tim also serves as director of the Oxford Private Equity Institute and is one of the founders of the Private Equity Research Consortium, and he is also a professorial fellow at Keble College, University of Oxford, and a research associate at the European Corporate Governance Institute. Welcome, Tim. And for those who don't know Luis, a quick background on him. He serves as head of applied research here at Burgess, and he has over 15 years of experience in quantitative research and modeling in finance. Now, he started his career at McKinsey in Madrid, and he has also served as director at BlackRock, a director at Axioma, and had headed the US research group at RiskMetrics. Luis holds a PhD in mathematics from Cornell University, and thank you for joining us today, Luis. Now, we're going to spend the next hour discussing preliminary Q3 returns, but also taking an updated look at the first 2 quarters of the year. We're also going to explore some holdings-based sector returns and answer the question of who's leading and who is lagging. And we're also going to be taking a look back at how cash flows had evolved during the early days of the pandemic, where they have trended since, and perhaps any lessons we can learn from this. Now, we're going to start first with some prepared comments from both Tim and Louise, and then we're going to move into a Q&A session at the end. So with all that said, let me hand it right over to Tim.
Great, thanks very much, Keith. And what I'm going to do is to carry on the story, really, of how the returns have looked through the first 3 quarters of this year. And for those of you who've been on these before, this is a sort of evolving story where we've been tracking it sort of in real time. In private equity, real time is always with a lag, as we know, since there's a reporting lag in terms of the data. And now at this stage, early in 2021, we actually have the data that was reported up to Q3, which I think has been really interesting, which I'll show you in a little bit. But what I'm going to do is just to very briefly recap where we got to before, for those of you who maybe are new to these webinars, and then really update it with the final Q2 numbers and the provisional Q3 numbers. And we're going to see how big both how big the hit was and how big the bounce has been, and whether indeed it's actually been continuing. The bounce has continued going up. And what I'm also going to do is to look at what it's done for longer term returns as well, at the sort of fund level. So rather than looking quarter by quarter, which is where we're going to start, we're also going to see what it does for vintage year returns. And then look at also what's been happening to cash flows and distributions, but I won't talk too much about that because Louis will be talking more about that in a minute. So in terms of the data that we're going to use for this session, we're actually going to be using the latest update to the Burgess data, which gets us through Q3, and that it's always worth remembering that not everybody has actually reported by the time in which the data is sort of put to bed for the quarter. So there will be a few funds which have not reported yet. And I'll also be using some of the holdings data, which will be goes down to the level of the sort of transaction, which is, I think, very interesting data. And I'm going to show you some new things showing how at the sectoral level, how returns have gone. So anyway, that's the plan. So if we have the next slide, please. What we're going to do is, and actually the next one after that. So what I'm going to do is to start off by just recapping the, if you like, the Corona quarter returns, which was the Q1 numbers. Many of you will have seen this before, but essentially what happened was pretty much across the board, there was a fairly sizable hit by the end of Q1. That, of course, was to some extent the darkest hour, at least in terms of financial markets, if not for other reasons. But the returns there were down across the board by about 8% at the end of that quarter. And you can see the distribution. As we've remarked on before, one of the remarkable things was how little venture capital was hit, and we'll continue that story in a little bit, but also, of course, how large the hit was on some other asset classes like natural resources, which is really the energy.
Hey, Tim, looks like we may have lost you. You still with us? Well, I guess we'll give him a few minutes and see if he rejoins. Maybe shall we pivot right over to you, Luis?
Sure, I think that sounds good, Keith. I'm happy to get started with mine.
All right, thank you.
Okay, well, while we wait for Tim to sort out his technology problems, I'll get started with what I was going to talk about. So in the next quarter, the next quarter hour, what I was going to talk about was essentially two topics. The first is something that Tim was going to mention, and hopefully still will, which is the balance of cash flows in and out of funds, i.e. the net cash flows. And then the second topic is how fund debt has evolved over the last few years. And of course, in both cases, I'm going to take a look particularly about what happened during the pandemic. So, right, so let's get started with net cash flows. So the quote, "The market can remain irrational longer than you can remain solvent," is obviously, it's a somewhat tired quote, usually attributed or misattributed to Keynes. However, it has some relevance to private capital. While ultimately what matters obviously are returns, in the short term, net cash flows, namely distributions minus contributions, are important. So for example, LPs with a mature private capital portfolio typically want it to be approximately self-financing, with distributions financing at least the contributions, and maybe leaving something left over. So any deficit caused by contributions exceeding distributions needs to be financed from elsewhere. Sadly, the times when contributions exceed distributions tend to not occur at random. Instead, they tend to happen at times of crisis. And if the excessive contributions over distributions requires selling more liquid assets, then this obviously can be painful, since prices are likely to be depressed precisely at these times of crisis. So as a result, clearly LPs have an interest in these kind of net cash flow issues. Incidentally, throughout this talk, whenever I talk about net cash flows, I will mean distributions minus contributions. So in other words, if net cash flows are positive, that means distributions exceeded distributions. Okay, so if you want to look at net cash flows, the natural thing to do is to simply look at these net cash flows directly from the Burgess Manager universe. So on this slide, I've plotted distributions going upwards in pale blue, contributions going downwards and shown in pale red, and then the net cash flows are in black. And this plot is for all the funds in our universe, but excluding funds of funds. So as you can see, for example, say looking on the left of the slide, you can see that during and after the GFC, net cash flows were very negative, and then rallied and became positive in 2013, which, at first seems plausible. moving to the right-hand side of the slide, for the last few years, the slide paints a grim picture, and indeed, it paints a very grim picture for the last few quarters. So is the conclusion that private equity has seen, or private capital in general, has seen declining net cash flows, and in particular, very negative cash flows recently? Well, I would say it's unclear based on what I've shown you so far, because what we really need to do is correct for an important effect before drawing any conclusions. So what this slide shows is the capitalizations vintage by vintage over the last couple of decades. And as you can see, the amount of private capital has grown dramatically over these last couple of decades. And this is particularly true in the last few years. So the reason that this matters is that obviously it is young funds that call capital most rapidly, and then middle-aged funds that do the distributing. So if capitalizations increase fast enough, then in aggregate, contributions are guaranteed to outstrip distributions, regardless of how well the funds perform. And in particular, given how rapidly capitalizations have increased recently, unfortunately, I would say the graph on the previous slide is almost worthless. So instead, what we want to do is to reweight our universe so that it doesn't exhibit this rapid change in capitalization over time. i.e., what we want is we want to make all vintages the same size. Another way of saying this is that we want to simulate a portfolio that commits a total of, say, $1 to every vintage. And then just as a technical side note, we further assume that that $1 is broken up amongst every fund in the vintage in proportion to fund size. So in effect, you can think of this as simulating a very mature, steady state portfolio. This simple analysis results, it turns out, in a very different picture from what we saw on the penultimate slide. So as before in this slide, contributions in red go downwards, distributions go upwards, and the net cash flows are black. So first, we noticed that just a little bit before the GFC really started, net cash flows in this methodology were actually positive, indeed, as one would expect, because the crisis hadn't really started. And this is in contrast to what we saw in the penultimate slide, where they were negative even before the crisis started. Then turning to after the crisis, net cash flows turned positive, as they did in the sort of the naive slide, 2 slides back, but they do so in this slide more rapidly than before, namely in 2010 rather than 2011. Then turning to more recent times, in 2018 and 2019, we see a decline in net cash flows, but the decline is pretty mild. Furthermore, the net cash flows actually remained positive, while in the naive analysis in this period, they'd actually had gone negative. And then finally, turning to the most recent period, turning to the pandemic, net cash flows, not surprisingly, plummeted in Q1 of 2020 and became slightly negative in Q2. But notice that it's nothing like what we saw in the GFC. And indeed, by Q3, they'd actually rebounded and become positive again. Although admittedly, they're still much, in fact, they're around a third of where they were a year earlier. So on this slide, I want to zoom in and look at cash flows for all global funds, but on a month-by-month basis, as opposed to quarterly, as I did in the previous slide. So this allows us to see the large spike in cash flows in March and April of 2020. This turned net cash flows negative for those 2 months. Negative cash flows occurred earliest in Asia, then followed by Europe, and then the US, which of course is in line with how the pandemic developed globally. However, after April, I would say that cash flows or net cash flows started to recover modestly. So next, I want to look at net cash flows by asset class, starting with equity funds. So in this slide, I subdivide equity funds into their tier 2 subclasses, namely buyout, expansion capital, and venture capital. buyout funds net cash flows were already declining slightly in 2019. Nevertheless, in 2020, they managed to stay positive in Q1 and Q3, and in fact, were only barely negative in Q2. Expansion capital fared even better than that, with net cash flows that were actually similar or even possibly better than 2019. And then venture capital did extremely well, showing some of the most positive net cash flows of recent years. And if Tim rejoins us in a few minutes, I hope he'll talk a little bit more about that. So a question one could ask is whether there's a size effect. So for example, one might wonder, are large funds weathering the pandemic better, at least from this net cash flow perspective? So one way to look at this is to just redo the previous analysis, but committing equally to each fund. So previously, if you remember, I said that we committed in proportion to fund size. So switching to equal weighting, it increases the relative importance of small funds and decreases the importance of large funds. So in essence, it kind of gives us an idea of sort of, is there a size effect? So we can see that during 2020, with equal weighting, buyout funds had somewhat negative net cash flows. Expansion funds were about the same, and venture capital funds probably returned larger positive net cash flows with the equal weight. So what we could conclude from that is that there seems to be an advantage for large funds, again, from this net cash flow perspective in buyout, and an advantage for small funds in venture capital. And I would say that we found this result for buyout funds, in other words, the fact that large funds seem to do slightly better from a net cash flow perspective, surprising, since what we actually expected was that large funds would have used fund level debt, which I'll be talking a little bit more about in a few slides, more aggressively, resulting, at least potentially, in larger spikes in capital calls during March and April. So there's probably a little bit more research we can do as to what exactly happened there. So next, we turn to the tier 2 subclasses of debt funds. Here we see very large spikes in capital calls during Q1 and Q2 from senior and distressed funds. In general, we see negative net cash flows during 2020. Distressed debt funds suffered some of the most negative net cash flows in Q1 and Q2, but then interestingly rebounded with large positive net cash flows in Q3. And then finally, in real assets, perhaps the most noticeable trend is the very decreased activity in natural resource funds, which Tim actually did get to mention, at least briefly, with negative net cash flows throughout 2020. This is mostly coming from energy funds that faced both the turmoil in the energy markets as well as the pandemic. So to wrap up my comments on cash flows, I just wanted to draw attention to the similarity between how I've looked at net cash flows and our recommended approach to performance benchmarking, namely the pooling methodology. And indeed, they both rely on constructing a portfolio of private capital that mirrors a natural question that the LP wants to ask, and then doing some kind of analysis once you have that portfolio. And you can read more about these ideas, at least from the benchmarking perspective, in the working paper shown on this slide. So next, I want to turn to my second topic, which is fund debt. So this is similar to what I discussed in a recent research brief titled The Rise and Slight Fall of Fund Debt, which is available from our website. So in terms of terminology, by fund debt, I mean borrowing undertaken by the fund as a whole. So excluded from this would be debt secured by any single asset of the fund. So for example, a real estate fund may mortgage a property, the mortgage would not count as fund debt. Or a buyout fund may own a private company where that company has borrowed capital, that company's debt would also not count as fund debt. But in contrast, borrowing against the uncalled capital of the LPs, which is usually called subscription line of credit or a subline, does count as fund debt. Also, any borrowing against the combined assets of the fund, which is sometimes called NAV debt, also counts as fund debt. And finally, I want to mention that my previous slides all use data from the Burgess fund level universe. In contrast, in the next few slides, I will be peering inside the funds in our universe and looking at items on their balance sheet. This data is part of our so-called transparency data set, where we track the underlying investments, investment holdings, and many other characteristics on behalf of limited partners. So on this slide, I plot fund debt minus cash, and I've labeled it net, and at least for the time being, it's in black. It's the only line. And I'll just call it net debt for short. If a fund calls capital, then it'll first show up as an increase in cash and hence a decrease in net debt. But if it's later used to repay debt, then it will decrease both cash and debt and hence have no impact on net debt. So sort of bear that in mind in terms of like when the different impacts on net debt will show up in this graph. So as we can see, net debt increased for equity and debt funds over the last few years, but net debt declined in all three asset classes in 2020. Note that the net debt for debt funds is much larger as a fraction of capitalization than for the other two classes. Thus, the decline in 2020 amongst debt funds, which seems gentler on this graphic, is really sort of an effect of the difference in the y-axis. And it's actually larger in dollar terms per unit commitment than for equity and real asset funds. A few extra nuances show up if we separate out net debt into debt and cash separately, where we can see that as expected, cash went up in Q1, presumably a result of increased capital calls. But for equity, and especially for debt funds, fund debt, which is the red line, also went up, which is a little bit surprising. We think this is a result of funds strengthening their cash position by both calling capital and drawing down credit lines. And then finally, in this slide, I separate out debt into two subclasses of debt that we can identify, namely sublines and other kinds of liabilities. And here we see those two kinds of debt moving in opposite directions in Q1. Subline debt increased, but other kinds of debt decreased. So what we think may be happening here is that because sublines are backed by highly rated LPs, it is relatively cheap debt, and hence funds tend to draw it down when they need cash. However, other riskier debt is more expensive, and furthermore, the lenders may impose constraints on borrowing more, and especially so at times of declining asset values. So we think that probably explains the sort of divergence in the red and purple lines on this slide. And hence this. So in summary, I started by discussing the balance of distributions from and contributions to funds. In order to properly understand whether distributions are truly exceeding capital calls or the other way around, it's important to use the right methodology. In this case, that means reweighting the data to simulate a steady state portfolio. Having done that, a very different picture emerged from the naive view. In particular, even in 2020, equity funds distributed more than they called, and venture capital had a gangbuster year with distributions far exceeding capital calls. Other classes of funds generally called more capital than they distributed, but there is light at the end of the tunnel. For example, distressed debt funds distributed more than they called in Q3 of this year. And then next, I moved on to a survey of how fund debt has evolved recently, and especially during 2020. We can see a pattern of increasing use of fund debt amongst equity and debt funds in earlier years. During 2020, fund debt net of cash declined, but fund debt in isolation, perhaps surprisingly, increased in Q1. And finally, you can read more about these trends in my research brief titled The Rise and Slight Fall of Fund Debt. So with that, I guess we can see if Tim can return to his webinar. Welcome, Tim. Oh,
You're muted, Tim.
Great. Okay. I hope that's all back now. Really sorry about that. In working from home for nearly a year now, my internet's gone down 3 times, and you saw the third time, I'm afraid. So apologies for that. But so what I was going to do was to sort of, if it's not too much of a jolt, pick up where I was before, which was to look at this corona quarter and to go back and say, well, you know, we've seen this before, for those of you who've been on these webinars before, but we saw a fall of about 8% across the board, with some pretty big falls for the natural resources and very little falls for venture capital. And so if we roll it forward another quarter into Q2, on the next slide, we see that actually the Q2 returns were pretty much a complete bounce on Q1. Certainly across the board they were, where we up by 7.9%, you know, against a down by 8.4. It was wiped out. But we then see some really extraordinary returns coming in from VC, where venture capital, with a relatively small Q1 effect, actually went up by, well, across the board by about 12%. And we also see that in the buyout space, most of the losses in Q1 had been reversed by Q2. This, by the way, for those of you who've seen it before, these are the final, as it were, the sort of final Q2 figures before we saw the preliminary ones. And so this is where they've changed a little bit since the last webinar we've run. Okay, so that was up to the end of Q2. Then what happened? Well, the really surprising thing for me was how strong the bounce continued into Q3. So again, we've pushed the Q2 numbers onto the right-hand side, and now we've got the Q3 numbers. These say preliminary against them for the reasons I said before, which is that not all of the funds had actually reported by the cutoff date, but a remarkable continuation of the returns, where we see, you know, just picking out a few, you know, US buyout funds, you know, went up by around 11% in that quarter. And now, of course, we know stock markets were also very strong in this period, so we'll look at that a bit more. But again, huge increases in venture capital returns, where US VC was up 15%, you know, on top of an 11% rise in the second quarter and only a 2% fall the previous quarter. So one of my strong predictions is that when at the end of, when we've done the 2020 numbers in full with the Q4 numbers in there, some of you may have seen this, where you compare what has been the top performing asset class over a calendar year. And VC has done very well on that over the last 6 or 7 years, and I think they're going to win 2020. I'd be very surprised if any other asset class came near them in terms of that. So that's what happened in Q2. Very strong continuation of the bounce, almost as strong as Q2. In fact, in many asset classes, it was as strong. So you have one month down, 2 months up, which is why the returns have been very, very positive. So if we continue the story then and look what's going on in a little bit more detail, one of the things I think is very interesting is if you go into the sectoral return. So this is where you're looking at transactions across the different asset classes, and then they're flagged within Burgiss by the sector in which the portfolio company is its main businesses. You see some very interesting returns over those quarters. And I think this is very intuitive. I think some of the results, if you're looking at the worst performing sectors, you know, energy again comes up, but it basically was hit in Q1 and there was a slight return, a slight sort of recovery in Q2 and Q3. If you look at other sectors which have done much better, obviously IT, information technology, is the standout performer really, with a very little fall in Q1 and then very strong performances in 2 and 3. And then you see other things which make a lot of sense. You see that consumer staples have done pretty well through this period, and you see real estate has done poorly, but maybe not as poorly as one might think, because by the end of the 3 quarters, it's about flat. Whereas clearly the real estate sector has been hit pretty hard, you would have thought, by rents and things like that. So I think the overall, if you look across the first 3 quarters of 2020, actually the year-to-date returns are about 12% across all those sectors, but obviously with some very big variation by sector. So that's an interesting insight, I think, into the data. And if you look at what this means for fund returns, I'm going to focus here in on the buyout and VC sectors, and then rather than look quarter by quarter, we're going to look at the vintage year returns for all the vintages up to 2017, because the more recent vintages don't really mean very much at this stage, since they may not even have deployed most of their capital. And we're going to look at the 3 performance measures: IRRs, money multiples or TVPIs, total value to paid in, and also public market equivalent returns, so where we compare them to the stock market. And as we've seen in the last couple of these seminars, these actually have been telling rather a different story, and I think it's now, the story is almost complete now. So if we look at the next slide, what we see is that if you're starting off with IRRs, what I've done here is put the returns by vintage year. So this is what, along the x-axis, is the vintage year returns. All these are net of fees and carry, so they're the net returns to investors. And the grey line is where we were at the end of 2019. So the Q4 2019 IRRs by vintage year. And you'll see that those are the sort of highest line across all these vintages, which means that when we track the performance by quarter, what we see is how much down on that performance are we at this stage. And you see the red line is the Q1, the Q1 numbers, which were very low. That was the low point. And then the light blue is it goes up. They went up in the at the end of the second quarter, and now we've got the darker blue lines, which is the third quarter returns. And you'll see there that over the quarters that those IRRs have been recovering, but in general they haven't recovered back to where they were. Now, you may be thinking at this stage, but I thought you've just said that you've had 1 quarter down, 2 quarters up. So why isn't that reflected in the IRRs? And this is, I wondered about this for a while. So maybe it's only my own question, but of course what's happening here is that the IRRs, these funds are going along at like a 16% IRR, and until it's not just that you have to recover, but you have to still deliver a 16% IRR for the IRRs not to drop. And what so far in 2020 that the funds haven't done that, so therefore the IRRs have gone down. But if we on the next slide, we'll see what happens to the money multiples, because money multiples clearly are sort of more absolute measures. So you don't have to earn a return each year in order for those to go up. And indeed, that's what we see, is that now the money multiples are on, I think, virtually all the vintage years are now higher than they were at the end of 2019. So they've all gone gently up, having gone down initially, the red line, then they've come up, and now they're above the grey line if you at the end of 2019 numbers. And so I think it is intuitive what's going on here, that the TVPIs, the money multiples, have gone up, the IRRs have gone down a bit, because the returns thus far in the year have not been enough to recover the sort of 16%, 15, 16% IRRs that they were running at. But maybe they will. When we see the Q4 numbers and the final 2020 numbers, we'll look. And there is a possibility that on an annualized basis, if you were just looking at 2019, the end of year numbers, it may be that we don't actually see COVID in most of these numbers, because it's essentially that the IRRs and the money multiples and maybe even the PMEs may look actually rather similar. Talking of the PMEs, on the next slide we can actually see. Oh no, I was going to say we'll just do a quick dive into the money multiples for a moment, just before we get to the PMEs. And what I wanted to show was the extent to which the US and Europe have looked different on the buyout side. So what these charts show is the red bars are showing the hit to TVPIs by vintage year on the funds in the first quarter, in the Corona quarter. And then the green bars, which have got a dark and a light green element to them, show the bounce, if you like, in the next 2 quarters, so the Q1 and Q2. And so the cumulative effect of that, the total size of the green bar shows the effect of the 2 quarters, Q2 and Q3. And I did this partly to see whether there had been much difference in the sort of markdowns in Europe or the US. I don't think there were particularly big differences. I suppose if you're looking at the charts, you'll see some bigger red bars on the European side, especially in some of the more recent vintages, which suggests that they took more of a hit, or maybe they marked down more. It's a bit difficult to know whether it was because markets have fallen more as well. And then we see quite pretty big recoveries in those. In many cases, the recovery, as we've seen, is greater than the actual hit, which is what we see in the macro level data. But I don't see huge differences between the sort of the performance of the European and the US funds in that data. So anyway, let's go on to the PMEs. And so these are public market equivalent returns on a global basis relative to the S&P 500. Now that's a hard taskmaster, the S&P 500, because if you're comparing the European funds, for example, to a S&P 500, that's going to be tough, which is why some of these PMEs are quite low. With a bit more time, we could compare them to local markets, which would show a rather different story and a rather more positive story for PME. But for this purpose, we're really looking at this. This gives us a sense in which how much the returns were sort of smoothed over this period. And what we see is that the grey line is where it started off in the year again, and the PME shot up in Q1, the red line, because the markets went down, but the funds weren't marked down as much. And we've seen this in earlier seminars where we're saying this is a clear evidence of smoothing of the returns. And the question is, well, how far back do they come? And the answer is they pretty much come back to where they started from. So the PMEs, are there or thereabouts where they were at the end of 2019. So in other words, there's been some big changes in stock market returns, big falls and then pretty big rises. But the buyout funds have moved pretty much in line with that over the 3 quarters, although not in the short term. So at the end of the Q1, you might be thinking, this is great. It's great to be in private equity, but on the other hand, some of that was a bit illusionary because the fund valuations had not responded as much to public market returns. And then in the second quarter, they didn't go up as much as public market returns, which is why the PMEs came back down. But so, essentially, that's why I say that at the end of 2020, we may not see that much difference between some of these performance measures and where they were at the end of 2019. So let's switch gear now and look at the venture capital. And as I said at the start, and Luis was saying earlier, venture capital has had a hell of a year. And here we see the IRRs and on the VC funds. And again, it's the grey is the end of last year, and we saw some reduction in IRRs over Q1 by vintage year. But then we see these pretty sizable recoveries, and indeed to the point where the effect that we saw in buyouts, where the IRRs hadn't recovered fully, for many vintage years they have recovered fully, and in fact the IRRs are going to look like they're going to be higher at the end of the year. than they were at the start. That's why you see some of the times the blue line is actually peaking above the grey line. So, not only have venture capital funds gone up in value, but actually their IRRs look like they're going to be stronger than they were at the start of the year. So the effect of that on the TVPIs, which we see on the next chart, is actually as you would expect, which is that now across the board, the TVPIs, the money multiples for venture capital firms, are higher than they were at the start of the year, which is why the blue line is now considerably higher. It's worth also pausing for a moment and just comparing this. If you get a copy of these slides afterwards, which you'll be able to get, you'll see that the money multiples on the buyout funds are considerably lower than the money multiples on the venture capital funds through this period. On pretty much every vintage year, that's true. And so we've got some pretty, that's one of the sort of reversals that's happened in recent years, is that the performance of venture seems to be exceeding the performance on buyout funds. So if we again look at the breakdown on the next slide between Europe and the US, I think that there's certainly, you see, there's a lot more steady, if like, I think there's more data and there's more funds in the US, which is why the figures look a bit less spiky across the board. I would say you see this big recovery in the TVPIs, relatively small write-downs followed by big upticks. And for Europe, it's a bit more patchy. There's some vintage years have done pretty well, but I find it quite difficult to read that data and to see the trends there, because they seem quite different by vintage year. But in general, most of these vintage years we're seeing positive effects after the 3 quarters, irrespective of whether they're in Europe or the US. So then, just switching to the PMEs, we see those on the next slide, that the PMEs did shoot up for venture capital funds because their returns went down barely at all during the first quarter when public market returns were falling. But now, again, they are trending higher than they were at the end of 2019, because the blue lines here are noticeably higher than they were earlier. So this is again indicating that this is that VC will, I think, be the top performing asset class, I suspect, unless something dramatic happened in the last quarter, which I don't think it did. So that's a quick look through the sort of vintage year returns. Just on the next slide, we can see what we're going to do is just switch very briefly into cash flows to look at what's been happening there. And again, I've been tracking this a bit to get a sense as to what's been going on over the quarters, or in fact over the months, because we can look at this at a more granular level, and it doesn't require quarterly reporting from the GPs, because this is the cash flows that the LPs are reporting through the Burgiss system. And so on the next slide, what we've done is continue to track what's been going on month by month, and in many respects this is the same data presented differently that Lewis showed. The top chart is essentially sort of October 18 to September 19, and then we've got the Corona sort of period on the lower chart on the right hand side of it, so picking up in about March, April onwards. And we've noted before that there was these big net cash flow, net cash contributions happening in that period, which seems to be subscription credit lines being called. And then since then, things have been getting what you might call sort of much more back to normal, that there aren't any particularly noticeable aberrations, as it were, through May through September, I would say. But you do see these big cash calls coming in March and April. And if we look at debt funds, we see a similar effect on the next slide, that we see again, when you have the benefit of the perspective of the previous year, those March and April numbers look pretty unusual. and sort of indicate that when in some ways probably many LPs were hoping that they wouldn't get called, there were some significant capital calls coming in from most of the from most of the funds. But again, it's looking like it's got back to normal since then. And then we've also got on the final slide here the real assets side, which tells a rather similar story. So not much new to report there, but there's the story seems to still be that there was some real activity going on in March and April, and less so after that. So just to conclude, the big story really is the continued bounce. I'm not quite sure what it is when a ball bounces up and then keeps going up, but it certainly did do that. Q3 was a very strong quarter for private assets, and in particular venture capital and indeed buyouts. And so we've now got the situation where buyouts have recovered their pre-COVID levels for multiples, but not for IRRs, whereas actually VC multiples are now well above their pre-COVID levels, and the IRRs are pretty similar. So they've managed to accumulate as strongly as they were previously. The PME shot up and then came back down, but most of the time they're a little bit above. Certainly for venture capital, that's true. And so we are seeing we've got sort of clear evidence that these were smoothed a bit relative to public markets, but at the end of the day, they've sort of they re-equilibrate, if you like, and the smoothing sort of washes through the system. So anyway, that's what I wanted to say. Sorry it was in two parts, and I'll now hand it back to Keith, who I think is going to field any questions.
All right, thank you, Tim. I am glad that we were able to get you back. And so to everyone in the audience, if you haven't done so already, please feel free to ask any questions that you have about today's presentation. There's a form, a window on screen that you should be able to ask questions. Now, as we wait for some of those to come in, let's kind of revisit. Can we go to the slide labeled 16? So it should be Global Venture Capital PMEs. I think you explained the perhaps strange look at this graph well, but I think it does kind of raise the question of what is the proper usage of a PME if it's potentially subject to these kind of short-term, unusual, I guess, looking returns. So first to Tim, and then I'd be curious to hear what you think, Louise.
Yeah, I mean, I think I would say that you've got to be very careful with PMEs when you have big changes in public market returns. I think that that's the sort of message here, and you shouldn't be sort of fooled by them, because these things can move around a bit weirdly when you have big market movements. Now, in some ways, if you ask an LP, so what would you prefer? Would you prefer them to be the returns to be a bit smooth, because or go really mark to market fully? I think most LPs would say we're fine with smoothing. It doesn't really bother us too much, and that is, I think that's understandable, as long as it doesn't lead you to believe that somehow these returns are by their nature less risky. So, it could be that if you look at some of these private market returns and you started trying to do things like estimate standard deviations or return or volatility of returns, then you might make the wrong call if you said, oh, this is great, because actually they sort of came back to where they were. They've moved in line with public markets, but they've been less volatile. I would say the underlying assets are just as volatile. It's just the reporting is less volatile. So as it were, don't crank up your asset allocation on the basis of risk, because I think these aren't really picking up risk. But they are, over a couple of quarters, they sort of get back to where they were. So I think it sort of washes out reasonably quickly, but don't be fooled by the lack of mark to market would be my message.
Maybe one pretty simple comment that I would add to what Tim said is that just in terms of the technicality of how PMEs are defined, and actually this also applies to the sibling measure of PMEs, namely direct alpha. You basically, you can think of these as similar, very, very similar to TVPIs and IRRs, but where you denominate the measure in a funny currency. So instead of denominating it in dollars, for example, you denominate in units of a index of some sort, such as the S&P 500. So from that perspective, the thing, oh, and then the other thing to notice about these is that they are sensitive to the kind of the unrealized, the valuation of the unrealized portion at the end of the fund. So as a result, in some sense, all four of them, IRR, TVPIs, direct alpha, and PMEs, they all suffer from this problem, which is that they're sensitive to the fact that that unrealized valuation at the end is to some degree subjective and lagged, as Tim mentioned, and so on. Now, in the case of specifically direct alpha and PMEs, they're furthermore subject to the fact that there's a mismatch between the amount of lagging that is going to happen in the private numbers compared to the index, which is presumably usually a listed, a publicly traded index, which is not lagged. So it's kind of like you get one source of sort of problems or issues already in TVPIs and IRRs, and then you get this sort of second mismatch in the case of direct alpha and PMEs. However, the final thing I'll say is that all of those issues essentially go away once the fund gets closer to liquidation, because at that point, all of these measures are based only on cash flows, which are not subjective at all. So they're basically it's a sort of a matter of fact, no longer subjective.
Now, on the topic of unrealized valuation, actually, a question came in that is quite interesting. So the Q1, Q2, Q3 returns, the question is whether those are largely based on the fund's estimates of their holdings values, right, and are not really tied to any distribution. I believe that's the case, but I was curious if either of you want to kind of elaborate on that topic.
Yeah, I mean, one of the interesting things is, of course, that generally speaking, the funds get audited once a year in the Q4 period, and so they may be using independent valuation experts or things like that, especially maybe in the buyout funds, but we won't necessarily see the full mark to market or the full effect of that until Q4. Now, I think historically it's true, though, that what we've seen when they have been audited is the valuations go up in those periods. There's a sort of Q4 spike, which is a bit, if you compare it to, if you sort of strip out the underlying movements in the market, you see a little, it's sometimes called the Santa effect, that, Santa Claus comes along and gives you a little bit more at the end of the year. So it might be that these are, that what that's saying is there is sort of that these may be a bit more smoothed out through Q1, 2, and 3, because they're not subject to audit for most of these funds.
Very interesting. So maybe changing gears a little bit, I'd like to jump into the slides that we showed. Could we go to the slide labeled 29? It should say simulate a portfolio equity. Now, looking at the shapes of, yes, that's the one. Looking at the shapes of these graphs, the venture capital cash flows seem surprisingly smooth in an asset class you would expect to be perhaps volatile. Any kind of comment on what's going on here?
Yeah,
Luis?
I mean,
Sorry.
well, I would first, I guess I would agree with that. In other words, just, I mean, there are cash flows, but just generally speaking, yeah, there's no question that the returns of venture capital tend to be, well, they're more dispersed, higher standard deviation. Not only that, I think probably you can say that not only higher standard deviation, but fatter tails. So, that would lead you to think that you'd observe more volatility in general in almost any kind of plot, including cash flows for venture capital. And as you say, particularly if you leave out one quarter, which is kind of a bit of a downward dip in VC, they do seem kind of pretty smooth. I guess one comment I would make is that the VC universe, at least by count, is somewhat bigger than the buyout universe by count. But having said that, it's not an enormous effect. Like, actually, Keith, feel free to sort of jump in, but depending how you count it and what region or what period of time, maybe VC is 20% bigger, something of that sort. So could the extra counts of VCs kind of add enough diversification to kind of get a bit of extra smoothing? Hard to tell. The one thing I would say is that at least if there is a count effect, that would be an interesting thing to look at from the perspective of this methodology that I've written about at some point a couple of years ago, called cash flows at risk. So that might be one way to kind of, it might be an interesting way to compare this issue on a more apples to apples perspective.
I mean, one thing I was going to add in is and it's a hypothesis. It's just that I don't know whether it's sort of showing up in the data, but these are cash flows, of course, and a lot of the very successful VC exits are IPOs, where the VCs don't get out immediately, and that they have to do that over subsequent years. And so, which is what we've actually found in some research, which I've been doing on the buyout funds, is that they stick around for a long time after taking a company public. The average duration of their holding period is about 3 years. So over that period, you're getting pretty steady cash flows coming through from sales of additional shares. And that's probably there in the VC data, I think, as well. So even though you might have a spectacular exit on paper, you may not actually show up. You may have to realize it over 2, 3, 4 years afterwards, which smooths out your cash flow effect a bit, even though you're probably booking the return in your fund, but the cash flows might be more prolonged.
Actually, that's true. And I guess it kind of creates multiple competing effects that you need to, it's an interesting point, Tim, because, for example, as soon as they IPO, at that point they're holding effectively listed equities. So at that point their NAVs are going to be subject to, and subsequent cash flows are going to be subject to the volatility of the listed equity markets. So there's that. Then is there a difference in that holding period on average between buyout and VC? So maybe that's kind of another issue. And then another random issue which just occurred to me is there some kind of a particular kind of diversification that may happen in buyout, where there's a general feeling that some segment is going to perform well. Different VC funds make bets on different particular startups that are attacking that segment, and as a result, you could imagine a situation where the aggregate returns are not, or the cash flows are not that volatile, while individual VC funds that make different bets are very volatile. In any case, that's a sort of a perhaps overly speculative hypothesis there.
It would be an area that could be interesting to explore further because it is a little unintuitive. So we actually have just 2 minutes until we're at the top of the hour, so want to throw a closing question at both of you, and it's a forward-looking one, which is always tricky, but any thoughts on what's going to happen in the private capital world in 2021? And perhaps a less or an easier one to answer is, what should we be looking for? What are going to be the topics of interest this coming year? Perhaps over to you, Tim, first.
Yeah, well, it's 2020 has been will go down, I think, as a very good year for private capital, and all the evidence I see is that investors are still wanting to increase allocation. So I don't see the 2021 being a year of retrenchment, as it were. We've had a strong 2020. Will 21 be less? I don't think so. I think that the sort of move towards private capital is continuing, and we'll see it moving. I think over time we will see it probably moving more into the retail space, which I think is starting in the US. As long as the new administration doesn't put a halt to that, I think that's one of the things I would really be looking at, because when this starts getting into direct contribution pension schemes, those are some big pots of money, defined contribution pension schemes. So I think that would be something that some of the policy issues towards private equity, I think will be very interesting to see. The other issue is, you know, venture capital has had a hell of a run, and will that continue? Without a great scientific evidence, I think it probably will continue, because I think we're in a period of great innovation where there's all sorts of possibilities of things to work on, whether it be, you know, AI or machine learning or pharmacy, or, you know, sort of biotech or all sorts of things. So I think venture capital flows will continue, and I think the returns may well, for the best funds, will probably continue to.
And over to you, Louise.
Thanks, Keith. I think all I would say in the remaining like 30 seconds, I think, is that, well, we saw that in terms of fund debt, just generally over the last few years, there's been this increase in fund debt. Then obviously 2020 was peculiar. It sort of flattened or declined. I would be interested to see whether the previous pattern continues and fund debt continues to rise, because I guess it's kind of balanced in my mind with, on the other hand, a sort of an increase in the sort of sensitivity or interest in fund debt on the part of LPs. And then specifically, we saw that some of the more kind of outlier returns in Q1 of 2020 seem to be driven by, well, typically debt funds with very large leverage. So I think there's some interesting kind of forces working in opposite direction on the fund debt front.
All right, well, those are definitely some predictions that we'll have to keep in mind as we continue through this year. So this actually brings us to the close of today's webinar. First, I want to extend a big thank you to both Tim and Louise for joining us today and providing your thoughts. And of course, I would like to thank all the audience for joining us today. Now, there are actually quite a few questions that we weren't able to get to during the session today, but we will be sure to follow up with you individually after the webinar. And then as a final note, could we go to that final slide? Please recall that you can access the research of both Tim and Louise. And the links to some of this research is up on the screen, and we can, of course, follow up with you after the webinar. So thank you to everyone, and please enjoy the rest of your day. Take care.